few days ago, I met a gentleman in Dubai. He's been introduced to me by a friend. And that was our first meeting. What I knew about him was he's a lawyer and he's enthusiastic about blockchain tech and probably everything that can add to our lives. I met him. He gifted me a book. It's called Bitcoin. The beauty of that gift is that that word is the only thing I can read of it. I can also read what he's written for me here in English. But on all other levels, I can read nothing because it's in Portuguese. Now, what he told me is, look, this is my book. I'm sure you'll love it when you read it in English, and probably an English version will be there soon. The gentleman left. I didn't get the opportunity to understand anything of it, but I was excited to know more about it. The gentleman is Daniel Gomes. He's a lawyer who talks blockchain and tech at a level that very few do. He understands blockchain and tech at a level that very few do. He's enthusiastic about prop tech and what we can add to people's lives at a level that very few do. So what I've done is I insisted that he comes in today and he tells me everything about this book. And I wanted everything about this book in English. So I grabbed Daniel. I got him on the brief today. So first, welcome to the brief for everyone. And Daniel, thank you for joining me on the brief, giving me part of your time and the opportunity to explain to me what happens between those two sides of the book, what happens within it, and why have you written Bitcoin? You're involved in many projects related to blockchain. You're a fundamentalist. You're not a hype-driven individual. So I would love to hear all about it. And first, start please by introducing yourself in detail to our community and our listeners. Go ahead,
Perfect.
please, Daniel.
Thanks so much, Makram, for your kind words and your gentle invitation for me to being here with you today. It is amazing to be with you and all the people that is listening to us. Well, guys, for those who don't know me, my name is Daniel De Paiva Gomes, and I am the author of Bitcoin, the Regulation and Taxation of Crypto Assets. The book was written in a taxonomy perspective. We will get to that later on. But just introducing a little bit of myself. I am a lawyer. I am used to deal with capital markets projects, taxation projects, everything related to digital economy, actually. My journey as a lawyer started back in my graduation, in my bachelor's of law in 2006. Then, since 2011, I have been studying and taking post-graduation courses, and I met Bitcoin in 2015 when I was enthusiastic about the technology itself. And being a tax lawyer also, I have sold, unfortunately, I have sold a little bit of my Bitcoin, and the question came to my mind, how should I tax it? So I always have been enjoying doing research, academic research, and I decided that my doubt probably was the doubt of so many others, not only in Brazil, South America, but all over the world. And I decided to take a master's degree on tax law, but focusing my research in the taxation of crypto assets. I tried a lot in 2015, but you guys can imagine, if we guys nowadays have some bias regarding Bitcoin and crypto assets, back there was even worse. So considering a master's requires a professor that would guide the student, at that time, unfortunately, I did not manage to get such a professor. But 2 years later, in 2017, I had the pleasure to be accepted at the School of Law of São Paulo at the Getulio Vargas Foundation. That is a non-profit organization, one of the biggest and most serious here in Brazil. I developed my research from 2017 to 2019 when I presented to the public the final version of my research, my master thesis. Fortunately, my work was graded and awarded as one of the best of the seasons, and this allowed me to present the paperwork and the full description of my research to Thomson Reuters editors. That is the editor that published my book in 2021. This week, and this is news for you too, my friend, I had the pleasure to know that my book is going to the Prime Library of Thomson Reuters editors, being accessible worldwide for people who don't have the opportunity to acquire the physical version. And I am also going to release the second version of my book, and probably until the end of this year or maybe the beginning of the next one, we will have the full translation version to English of the second edition that is bigger. We have something related to NFTs, DeFi, so on and so forth. And in parallel, I decided to move on with my academic studies because since 2018 approximately, I have been advising several crypto projects on several areas. So crypto gaming, tokenization of on-chain and off-chain assets, real estate tokenization, and many others. I really got on to this blockchain vibe, and because of that, I am taking my PhD in the School of Law of the Pontifical Catholic University of São Paulo, and my work is being done regarding blockchain and its use in the law courts. The idea is to understand how we can give predictability to people regarding binding judgments that are taken by the superior courts. And I was always digging deeper on the law perspective until a moment came that me and my partner and brother, Eduardo De Paiva Gomes, he also is a researcher. He has been developing all these projects beside me. He's the author of a book that analyzes NFTs and 3D printing. His PhD is about metaverse. So you can imagine that me and Eduardo are like soulmates in crypto. But we noticed that one very little but pretty important thing was missing. Probably more proactive suggestions of modification of some products and projects in order that they could healthily thrive. And this would only be possible if we get more knowledge about the technology itself. So there was a point in time that some projects, because of their very disruptive nature, they would not be able to succeed without some kind of stop order of the regulator, fines, penalties, and maybe even criminal sanctions. And the clients, and the founders of the projects that we were advising, they asked us, so please make suggestions to modify the product. So at least in this moment, in this history of humanity, the project can go on. And in the future, maybe when we have more clarity, we can make the adjustments that would be needed to achieve the original aspect. And considering this, we understood that it would be interesting to get to know the limits and the boundaries of the technology itself. So we had the amazing pleasure to be accepted with a scholarship to University of Nicosia, to their Master in Computing Science of Blockchain and Digital Currency. So me and Eduardo, since last year, we are taking this MSc, this Master in Science, to open up more, a little bit, our views about the how we can use blockchain and other distributed ledger technologies to its best. So it's being a tool for us to like connect, make a bridge. I used to say that everything is meta because it deals with fiction, it deals with language. So law is a metaverse, has its own fictions. Technology is a metaverse by itself if we are talking about meta language. So if these are different blockchains, I am trying to build a bridge between them. I am trying to make a cross-chain so entrepreneurs can navigate on this blue ocean opportunity that is Web 3.0 with legal certainty and predictability about the possible outcomes and legal outcomes that could come from these projects.
So guys, when you've listened to Daniel now, you would have discovered that I have under introduced him rather than introduced him beyond what he does. Again, as I said, if there is someone you need to listen to when it comes to blockchain and everything, all legalities related to it, and that's a very big subject because we talk to the world today, and the world needs to understand that that there is a way to do things in a legislatively right manner. Yeah, people are not all bad people who wanna just skip laws and be non-regulated. I believe the best of the people and the people who want all of blockchain and blockchain tech and whatever is related to go mainstream are fundamentalists, people who want to do things right as per the regulation and want to be regulated. Actually, they find it difficult. We're a founding team, Daniel and myself, with other amazing individuals on a small project, and small or big, it's a big project, and it's very interesting to listen to someone who has the voice of reason, yet exactly what Daniel mentioned now. He understands tech. He understands the limitations of tech and the possibilities, wants to be regulated. So when we were talking about which jurisdiction should we develop our structure in, we didn't go for the jurisdiction that allows us the biggest leeway. We went for the jurisdiction that allows us the most clarity, because clarity is key to allow us to develop and take things mainstream and develop sustainably. Daniel, your book deals with taxation as well as other legal aspects of Bitcoin and NFTs, as I do understand, yeah? Taking into consideration that I wasn't able to read anything about it. So that's a big subject today. Yeah. Is there a clear cut today? If I hold Bitcoin and I'm in a jurisdiction where I am taxed, luckily I'm in Dubai, so I'm not taxed, and I don't hold Bitcoin, and this will shock people. So, and I don't hold Bitcoin. I've never bought Bitcoin, and probably I will never buy Bitcoin. But if I'm in a jurisdiction that is taxed, how will I be taxed? How should I report that? And this is a big subject, and I believe there is SEC mess currently in the US with many individuals and corporations because of that. Is there a clear answer for that?
Unfortunately, we have no clear answer in a broad perspective. However, several countries have already issued some guidance regarding how to tax, how can I say, positive results arising from crypto assets operation, mainly Bitcoin. For example, we have the federal, the tax authorities from Singapore. They have a very detailed Q&A regarding how to tax crypto. Here in Brazil, we have partially clarified some doubts regarding how to tax crypto, and the United States too. But I am used to say that people, regardless their country, okay, they should understand that mainly all these countries, they have what I call residual rules. So it's very dangerous to think that because you don't have something specifically addressing crypto, Bitcoin, and all other crypto assets, you are not obliged to tax. This is not true. It is important to get the support of an accountant or a tax lawyer of your local jurisdiction to understand if there are such residual rules that would embrace all kinds of positive results from many other activities. I am used to say, for example, here in Brazil, we had the first, how can I say, formal rule regarding crypto in 2019. People mistakenly believe that they only should tax Bitcoin from 2019 towards, and the period before it would not be taxed. This is a mistake. Why? Because here in Brazil we have residual rules that would tax any asset that, if sold, generates something that is bigger than 35,000 reais. And for example, it is important for people to know that you always, in most jurisdictions at least, will have two kinds of manifestation of a positive result that would need or require taxation. The first one is income. Generally speaking, most of countries, and this is a concept that varies from country to country, but broadly speaking, income is something that you earn because you worked for it or is a product of your capital. So you lock up your capital, you're receiving interest, this is income. I delivered, for example, a legal opinion, I was paid in for this service, this is income. However, if I buy an asset and I hold it for some time, I bought for 100 and then I am selling in 3 years from now for 300. This difference is what we call capital gains. And capital gains have specific rules of taxation that are different, generally speaking, from the taxation of income. So people should always be aware that they need to understand how they use and how they received the crypto in two different moments, the acquisition moment and the selling or barter moment. These are two different moments. For example, if I deliver a legal opinion for a Maltese client and he pays me in Bitcoin, it is worthless if this payment was in Bitcoin, in real estate, in dollars. I received positive results arising from my work, so I should tax it as income.
Okay.
If I decide not to sell this Bitcoin and I will hold it for 5 years, in the future, it will be taxed again, but not as income, as capital gains.
So it will be taxed twice, once as income, and then because it's held as capital gains.
Exactly.
So let me ask you a question over here. Very interesting subject, probably, and there's flood of questions that I get every day about that. So the first question that comes up here, if I receive today US dollars, and I'm in Europe, my currency fluctuated to the US dollars, and I held those US dollars for 5 years, and the value fluctuated. Would that be capital gains that I need to be taxed on the minute that I transfer it back to euros?
Depends on the local regulations.
So
for example, there are some countries.
If I'm in Brazil and this happened between the US dollars and the Rai,
unrealized gains should not be taxed. This is a general rule and
but
a very important
when I transfer
point.
the US dollars back to my local currency, it's realized, yeah?
Yeah, depending on the values involved, yes, you should have taxation upon this manifestation of positive results. But we have also specific rules that would deal with the exchange of foreign currency. So we have a specific regime for that that would lower or cancel the taxation.
Because anyway, if I received that money and it sat on my balance sheets in dollars, it should probably stay in dollars on my balance sheet. And then I haven't achieved a profit on it, although the bottom line may have changed in my local currency. Yeah? So, okay. Yeah. Let me ask you another question here. I have a partner, and I have a company that is a think tank. It's a crypto think tank. It's called GM Research and Advisory. My partner there, Fadl, his family business is a hotel business. Fadl is a young gentleman, was able to convince his family to take some money and put it in crypto early on. So obviously he did great with that money, and he made big profits. I'll not mention the name of their business auditors, but they're one of the big four.
Perfect.
They weren't able to account, or they weren't able to give him rules to account for those on his balance sheets. Now, he doesn't need to do that for taxation reasons, because we are in an environment here in UAE where there's no taxation, especially on capital gain. However, he needs to account for that because that money is, and that profit is a company's profit, and that's it's not a small organization. It has partners, and there's different elements that work within the liabilities and within the earnings within that company. So, is that the case, for example, that you see everywhere else, or no? Do you see it sorted and there's a standard, called it an international standard, where it can be applied on a company and on profits and on cash flow that is generated from holding blockchain related or crypto assets?
Perfect. It's an excellent question, Macron. Actually, I should highlight at first the following fact. We should never try to build a closed concept or golden rules that would be applied for all crypto assets, because we have so many different categories. And that is why, for example, in my book, in the front, there is a taxonomy of crypto, because taxation will follow the functions performed by the token, by the user. So if I'm using it for holding purposes...
So it's defined by utility, in other words.
Okay. Yeah, perfectly. The utility regarding this token. In the case you described, for example, it would be interesting to get to know if the country was the company settled is a country that follows the IFRS rules, that it is the international standards for accountability rules, right? But if
it does,
it is,
it's the UAE. By the way, guys,
perfect.
We're not doing tax advice over here. Okay, it's just opinions. Daniel is a lawyer, probably not a tax advisor. Neither am I. So,
actually, Macron, I am also a tax advisor. Perfect. So the question is amazing for me.
You're taking tax advice from Daniel, not from me. Okay.
So the thing is that we already have some papers, especially from the OECD, okay, from the Organization for Economic Cooperation and Development, and we have some studies from international boards of accountability all over the world. We have an Australian paper, an Australian report on this that is very interesting to get contact with. And broadly speaking, what they say is that, as a rule, crypto assets are not financial assets. Okay, this is very important. However, if I am talking about a security token, obviously, we are talking about a financial asset. That is so important. That is why it's so important to focus on what is the real nature, what is the real utility, the function performed by the token. Considering Bitcoin, we would have accountancy for that in the following perspective. If I am using Bitcoin in the day-by-day business of my company, so this is my main activity, I want to day trade Bitcoin, I want to swing trade Bitcoin, this would be qualified as inventory, okay? So we would account this classically as inventory as any other kind of goods. However, if I am holding Bitcoin, and holding Bitcoin is not the main activity of my company, as it looked like in the case you described, this would be an asset that is expected to be sold only in a very long term. Considering this, we should not qualify it as inventory, but we could qualify it as investment. But in my opinion, the best way for it would be intangible asset. I used to say that if we start from inventory against intangible asset, the chances of doing some mistakes are very, very low, because you can basically focus on the way you are using crypto. So anything that is intangible and you use in the course of your business would be inventory. If not used in the natural course of your business, you would qualify for accountancy purposes as an intangible asset. These are the best practices all over the world. These papers are mentioned, they go through this path, but it is important to highlight the fact that depending on the country, you may or not have some kind of divergence regarding inventory, because, for example, in Brazil, depending on the perspective you get, you can understand that you should qualify it as a financial asset in your balance sheet. So I would say the standard rule, it would be inventory against intangible asset. However, it should be important to understand in your local legislation if financial asset is not the position taken by the regulator.
So it's important to say, first, there is international standards then that are applied on this. Second, it's not a currency. It's either inventory or intangible asset, so it should not affect your cash flow statements. It sits on your balance sheets either as this or as that. And that's amazing, by the way. You know how far? So on the side of GM Research and Advisory, we have a small closed fund because, as you know, I never bought Bitcoin, but I bought Bitcoin as part of a fund. It's a closed fund, my money and his money. And we found it difficult on how should we account for those assets, yeah? And accountants that we've assigned found it difficult to also account for those assets, although they're international accountants. Amazing news, Daniel. I believe everyone is enjoying what you're saying right now. Now, we account for them that way. However, how do we revalue them? So for example, today, if I hold an asset on my balance sheet, I am required to revalue that asset within spans of time, depending on the country and depending on the nature of the asset. Some of the assets can sit on the balance sheet at the same value of purchase until I sell them. Some others can have the value change so that I can benefit from a positive loss or a taxation wise or a gain or report a gain. So how should I value those assets or revalue those assets? Is there a one size fits all, or no? It's country specific and there's no standard for that.
Well, I should say that also I don't see there is such a hard standard or international standard for it. It is also, I just remember, it is worth noting that all the accountancy problems regarding crypto, I described in chapter 4 of my book. That is why I like so much of talking.
It took me time on chapter 4.
But answering to your question, I would say that depending on for example, here in Brazil, if we go for the financial asset qualification, we should open a sub-account to control the volatility of the crypto. Because if the taxpayer does not do that, the unrealized gains will be taxed. But this is only the case if I am qualifying it as a financial asset. When I'm talking about inventory and intangible asset, I will apply all the normal rules for accounting, inventory, and intangible asset. So I have some rules that should be applied when I have an expectation of non-realization or non-achievement of a positive result. And this would open a window where you can reevaluate your asset. So this is an example of a rule that could be applied to do the reevaluation of your portfolio. But it always depends on the expectation of realization, of selling, of bartering, exchanging, and probably considering it's a closed fund, it's a long-term perspective. So all the rules that are applied, for example, to intangible assets, they could be used. There are some concepts, some accountancy concepts, however, that we are not able to use. For example, there is something regarding the usage of an asset that leads to its consumption and at the end of the day, its destruction. In crypto, we cannot do that. These rules, they are worthless for crypto because I have no material consumption that would lead to such destruction of the asset. This asset actually does not exist. It's an input or an output in a great balance sheet, decentralized, that is called blockchain. So this should be taken into consideration when reading all the how can I say, the tools that should be applied to evaluate an asset. We should have a very strong mindset on, is this really applicable to crypto? Because crypto is an asset that is not subject to consumption or destruction in a material sense.
You know, there's a flood of questions. I hope that Dennis was with us today. Dennis is the CEO of Blocksquare and Ocean Point, and he's part of Blockchat. He's my partner in the show in Blockchat, and he would have loved to be here today. Unfortunately, we decided on very short notice, so he wasn't able to be here. But I am sure if he was here, he would ask a question about. So you've mentioned now a few things that would be pointed. So I will ask you all the questions together and then we'll deal with each. The first is, you mentioned that not all crypto assets are alike. So NFTs are different than coins. The second question is, you mentioned bartering of assets. So if I have Ethereum and I buy Bitcoin with the Ethereum and I don't go into a fiat currency, what is this considered? Am I changing an intangible asset to another intangible asset and it sits on my balance sheet without revaluation, or am I revaluing that? The third question is, whenever I'm holding the asset, and you mentioned here that if I am holding the asset and there is benefit of it, so if I'm staking it, in other words, or probably you didn't mention that, you mentioned something else that triggered this. If I'm staking the asset, let's say I have Tether and I'm staking it and I have benefit out of that, how is that taxed? How is that considered? How are those staking rewards put on a balance sheet? Let's start, if you want, with the staking. And then we'll go backwards.
Perfect. I love to speak about staking and mining and not all other, how can I say, original acquisition of crypto. So we have to understand that we in the media, and you pointed out in the beginning of our conversation, we should be careful with the hype, right? Because, for example, there are several crypto gaming projects that they say, here, staking, but this is not actually staking, this is lock up with yield. There's no problem with that, but this is not staking. We have mining and staking as two options of achieving consensus on distributed ledger technologies that are organized in a block perspective, what we call blockchain. So proof of stake and proof of work rewards should be analyzed together. But staking rewards that are not really staking, I would say this is like stashing or just locking up with yield, should be analyzed together with DeFi. So this is two groups very different. Because
so can you differentiate and show me the difference between the two groups? So what Daniel is saying here, guys, is whatever you call staking is not staking. Okay, so it's something else. Call it whatever action you want, but it's not staking. Similar to, I've watched a show a few days ago about the metaverse, and they were talking about real estate on the metaverse, and I said there's no real estate on the metaverse. If it only exists on the metaverse, call it anything else. But if you call it real estate, it needs to have the dimensions of real estate. And it doesn't, obviously, because the first of those dimensions is it's really physically available and present. So amazing. So guys, the world, where are you, Daniel? Why do they take on shows people who know nothing about that? So
yeah,
I'm here on a free educational session myself, guys. So staking, or what you call staking, guys, is not staking. What's the difference, Daniel?
I used to say that it's not staking in a consensus protocol perspective, because to be staking, you are giving your asset, your token, as a collateral. Then you are eligible in a random function elected by the protocol. You are eligible to become a validator. So the results that you get when we are talking about staking in a proof of stake protocol, okay, they are result of your work. And then they are income. This is very interesting to get to know. So proof of staking has a concept that I become eligible to forge the next block. And then the other stakers will confirm if what I did is right or wrong. So we have several people being remunerated, being paid because of the performance of an action. Very similar to what we have in mining, Bitcoin mining, but with a difference. In Bitcoin mining, I do not need to collateralize my crypto. Instead, I will use
computing
the hardware, computing power. So, but at the end of the day, it's the computing power that is my ticket to be a validator. And then I perform the validation. In proof of stake protocols, this ticket is substituted by the collateralization of your tokens. And then you become a validator. But at the end of the day, both situations, you are receiving something because you performed an activity. And we have two kinds of remuneration in these protocols. I will take the example of Bitcoin first. We have the sub-seed block reward that is paid here. I say paid, but it's not actually a payment.
It's rewarded.
Yeah, by the protocol itself. It's like you are planting soy beans, and then the soybeans born, and you collect the soybeans. Or you installed in the rooftop of your house some energy hardware. Actually, you are creating this out of nowhere, out of thin air. So sub-seed block rewards are just like that. They are an original acquisition of assets. And when you look to the blockchain, this confirms you. And why is that? Because you don't have an input transaction that is sending to the output address of the validator. Instead, you have what we call a coin-based transaction. So blockchain tells you what is a sub-seed block reward. It's something that has as an origin a coin-based transaction. But this is just the first part of the remuneration. The second part are the transactional fees. So anyone, any participant of the transaction, if I am sending Bitcoin to Macron, will be able to give like a tip, an extra payment to attract validators to speed up the validation of our transaction. So this is very interesting to know. In this sense, we have an actually payment because I have an input, for example, my address that is going to the output that is the address of the miner. In proof of stake protocols, we have some difference to be taken into consideration, but this is a general rule because proof of stake, we have what we call pre-minted tokens. So before doing the ICO, the developers and the founders already have the supply of 100,000 million tokens. So this means that in the end, the majority of proof of stake protocols, when you stake, for example, in Cardano, considering we are talking about a pre-minted protocol, you are not receiving sub-seed block rewards. So this is not an original acquisition of asset. You are receiving transactional fees. And because of that, we can see that as a remuneration for the provision of services. Okay? But note that we are always talking about an activity that is being performed. One thing very important, many of the pools exist because we have thresholds to be a validator. For example, Ether 2.0, we need to have 32 Ethers to be eligible as a validator. If I don't have that, what we have? We have the figure of the staking services providers. Many exchanges do that. So what do they do? They get a pool of assets and they become the validator. And after that, they distribute the profits. But at the end of the day, this is different from doing the staking it by yourself because you are not performing the validation activity.
And this is different to what people know as staking because that is a totally different activity, whatever is called staking today, yeah?
Yeah, and that's when we go to this, how can I say, different staking or this lockup plus yield. For example, we have crypto gamings that you lock up your token and then you get some yield in exchange. But you're not validating any transactions. You're not, for example, if I am locking up AXS in the X Infinite protocol, I am not validating transactions inside the game. No, this is just a stimulus. You want the user to lock up the tokens because there is less tokens in the supply, okay? And the value increases because you have scarcity.
Yeah, you're not utilizing those in any other activity. So it's not even a lending, borrowing activity. It's just exactly as you said, it's locking up.
Yeah. So this is different than the proof of stake staking because in proof of stake staking, we have an activity being performed by the person. However, in this lockup staking, I am just locking up my coins, my tokens, and I am being remunerated by that. So this remuneration is not by the provision of an actual activity by myself, but instead is a remuneration of my capital. Very similar to what we do in DeFi protocols, right? Yep. So this is the greatest difference between these lockup staking programs / DeFi together with proof of staking remuneration and proof of work remuneration.
So taxation, there are different activities. This is capital gain. Here is income gain, or income taxed because you have it as an income. Cool.
Perfect.
So we go backwards and we say the revenues, be it mining revenues or be it any other kind of staking revenues, should be categorized based on what is the activity done to earn those revenues. And then based on that, they will be taxed, and how they will be taxed depends perfectly on what activity you're doing while earning those revenues. Perfect.
Amazing. Perfect.
So what's the difference between, you mentioned there's a big difference in the beginning of our discussion between different kinds of crypto assets or blockchain related assets. So NFTs are different than regular non-fungible tokens, or different than other coins, okay? Crypto coins. What's the difference and how would we differentiate them?
Perfect. The first thing to have in mind is that we have some civil contracts that they are applicable only to infungible assets. And we have others that are applicable to fungible assets. So when you are establishing some kind of civil relationship with a third party, it is important to get to know if the model of this legal relationship is able to embrace the two categories, fungible and non-fungible. Having this in mind, we can go for different differentiations about differences about the tokens themselves. Because when I am talking about Bitcoin, I have the qualification, as I said, between inventory or intangible asset. This is the good standards nowadays. I cannot say that is binding, but there are solid grounds to sustain the accountancy qualification like that. But let's imagine I bought an NFT. We have so many types of NFTs that we need to look what is inside it. For example, if I buy an NFT that grants me the ownership of a collectible of Spider-Man, for example, this would be similar to buy the actual collectible of Spider-Man.
Because it's a digital representation of that collectible. It's not the asset itself, it's just a digital representation of the asset. Okay.
Perfect. And we have also cases in which the NFT, besides having this digital representation, actually is a ticket or a voucher that you can redeem to get the physical asset itself. So if we buy an NFT of a sneakers, depending on the rules of the NFT, you can redeem that for the physical sneakers. So in my perspective, people who bought these NFTs, the main desire behind it is to have the physical NFTs, the physical sneakers. So we should account and tax it accordingly. We have other NFTs, for example, that they are a digital representation of a real estate. And then we need to understand by the limits of the local jurisdiction, if we have the actual tokenization of a real property, then these would be real rights related to a real estate property, or if we are talking about personal obligations, so economic rights that are related to a real estate, but that they do not confuse themselves with the ownership, because the ownership would remain with the person that is actually owns the real estate property. For example, there are countries nowadays that they allow the transfer of ownership of real estate by blockchain. In these cases, if I am talking about an NFT, probably I am talking about the transfer of the asset itself, of the real estate. So I should account the real estate in my balance sheet. Different from, for example, Brazil. In Brazil, we cannot transfer ownership by tokens because we need to register in the real estate registry all the transactions of ownership of real estate. So this takes time, this is bureaucracy, this is costly. So people do what? They extract some of the economic rights of this real estate, but the real estate remains with Daniel, for example.
Some or all.
Or all, yeah. some or all. And then this token is sold to Macron. When you are going to to register in your balance sheet this, you should look to the economic rights related to this NFT in order to do the correct qualification
and
of
here
this.
It's the same if it's NFT, a non-fungible token or a fungible token, yeah? It's the same.
Perfect. For example, if I am talking about a security token, I should account as a financial asset, different from Bitcoin that it was qualified as inventory. And different, for example, from a utility token of a crypto game that you use to breed or to upgrade your character. So we need to understand the taxonomy and the functions
so
performed.
Here, how do you look at an NFT that represents a case? So an NFT that represents no physical asset, it's just to be used as an avatar, or it's just a cool punk sort of speak. How do you, I have my own opinions on that, but how do you look at it from a legal and a tax perspective?
Perfect. The NFTs, in this sense, they are only on chain, so we have nothing off chain, and we need to understand first for what purposes will this NFT be used, and also if there is any passive income embedded in this NFT, because I am aware of the fact that there are some NFTs around the world that by the mere fact that you hold it, you will receive some yield month by month. In these cases, there are strong arguments to say that this is a financial instrument. Yeah. And probably who issued then should be aware of the fact that they should be worried about how it tests, financial instrument test, because this would be an NFT that is a security.
Because it's similar to the staking, non-staking today, the locking of coins and the revenue that you generate without any activity. It's capital gains, isn't it?
It would be at first income arising as a product of the capital, but because they are holding, once they sell the NFT in the future, then they should accrue for capital gains.
And so it's a financial asset, not a pure capital gain, because it's the NFT nature itself, the nature of that NFT cannot be classified, as you mentioned, as inventory. So that's why it's classified as a financial asset.
In this case, yes. But for example, if I bought an NFT and I am going to use this avatar to play a game, so I would qualify this as inventory.
Okay.
Or if I am, imagine we decided to have a scholarship crypto gaming enterprise together. So if I buy several NFTs of several avatars of different games, I am not planning to sell them. Why? Because I want to hire people inside my company to pay these people to play with these avatars. So I would qualify all these NFTs, all these avatars in intangible assets category. That would be different if we are building a swing trade or day trade company that would start, for example, I buy in private sale the NFT or the tokens, I wait for the profit and then I sell it. If this is a short term, probably I would go for inventory. That is why it's so important to understand not only the functions embedded in the token, but how the person that holds the token or the NFT will use such asset.
The best thing we can tell here, people who hold NFTs that have no meaning and do nothing, is that you do not need to worry about taxation so much, because it seems that no one will tax you. So even if you hold something that's worthless, in my view at least, don't worry about it. At least you'll not be taxed. You have no liability attached to it, most probably. So the second question, and I really hope Dennis was here. You talked about the taxation of tokens related to real estate. You know, at Blocksquare, what we do is we tokenize real estate. We tokenize economic rights behind real estate because we needed a solution that is universal. And in every country all over the world, you can't tokenize economic rights, but you can't, except in very few jurisdictions, look at the property itself. And sometimes because there's bureaucracy, sometimes like in Dubai, you know, all our title deeds are on chain, yeah? When you get a property, buy a property today, you get a title deed that's recorded on blockchain in Dubai, okay? And it happens in a few minutes. It's amazing. And that started probably mid 2020 to end of 2020. Okay, yet you're not able, because of many other reasons, and there's legacy reasons that come with land registrars and how you hold land and how you record land and who's allowed to buy land and how much is he allowed to buy in land. So there's many complexities there that I would call them all logistical. It's administrative. I don't call them any beyond that. However, because we tokenize currently economic rights behind the property, you see those tokens and people who hold those tokens are not seen as holders of real estate. So in a way or another, they do not hold the real estate behind it. Would that be classified as a financial product, that token? Or would that be classified as inventory? And the revenues that are generated from those tokens as well.
Perfect. We should probably take like a deep look in the white paper to understand how is the periodics, when we have the payments, what are the triggers for such payments. But I would say that both qualifications are possible. Imagine that the mere fact that I hold the token grants me nothing. I just hold the token. Okay, this probably should be qualified as inventory. If I am planning to do this in the natural course of my businesses. However, if this is not the case, and this is like, I am a law firm, and for example, recently my law firm is accepting payments in crypto, and imagine that we received as payment for the legal services these tokens, these economic rights of real estate that were tokenized. We probably would not sell them. So in our balance sheet, we would qualify them as intangible assets. Okay. But if in my company I am wishing to consume, to trade these tokens, or to do anything else with them in short term, probably inside the fiscal year, okay, and this would change jurisdiction by jurisdiction, but this is the most common perspective in many of them. Then we would need to understand, does the mere fact of holding the token grants me anything? If not, probably you're going for inventory, because inventory would be a residual qualification arising from intangible assets, okay? So any intangible asset that is used in the natural course of your business would be inventory. This is the flow. But if I have something that fulfills the concept of financial instrument and grants me some kind of yield,
rent,
some
for
kind
example,
of revenue.
if you collect rent, because at the end of the day, the property is earning rent.
Yeah, probably in these cases, I would say that the financial asset category would be the most suitable for this kind of tokens.
Perfect. So we classified those as financial assets. Now we'll go to back to our second question. We know the differentiators now between one asset and another, and how do we hold them and how do we dispose them. You mentioned, however, before that, one of the questions was about the asset that you hold, or the financial instrument, or the crypto asset that you'd hold, and how do you transact it, and do you transact it within the interim of a fiscal year or not? So do I understand from you that it's how many times the consistency of transacting it that defines how is it accounted for? So is it that if I hold it for a long run, I would be considered just a holder of it? However, if I'm buying and selling it within a 12 months period, multiple times or multiples of it, then I would be considered trading it.
It is important to know that this is one threshold to measure and to qualify for accountancy purposes, the tokens. But people should also be aware of what are the main business performance, because we have the main activities developed by the company. Let's take the example of my office. We provide legal services. So anything that is not related to legal services would never fall in inventory. What we would have in inventory, probably tables, chairs, something like that. But the tokens would be intangible assets.
Okay.
And this, regardless regardless the period that I'm expecting to hold. So I put in my balance sheet on something that would not be realized in the same fiscal year, but this happened. Oh, okay, because I am talking about an asset that has no connection with the main activities performed by my company. So I would tax these tokens that were sold as capital gains because I am in a civil law jurisdiction. This is very interesting. And I just remembered that a little bit earlier before we were talking about barter between tokens. And this is a very important issue because depending on the jurisdiction, this barter may be taxed. For example, in Brazil, unfortunately, the barter between tokens is taxed. But we have other jurisdictions that do not tax barter between crypto to crypto. They only tax the cash out to fiat currency. And this question regarding to tax or not to tax, this is the question. You know, I'm only missing a skull in my hand just to play like Shakespeare here. But we should be aware of the local legislation of your country. And there is this report, the Taxing Virtual Currencies from the OECD that I mentioned before. I recommend everyone to read it because they have like a mapping and a very interesting detailment of the positions that, broadly speaking, are taken by several countries. For example, if I have barter as a taxable event, imagine I bought Bitcoin by $50. I sold, actually not sold, I bartered this Bitcoin that now it is $300. I barter for the Blocksquare tokens. This operation.
Good idea, by the way. Go ahead with it.
I imagine so. Yeah, this operation would be taxed not because I am exchanging Bitcoin for the Blocksquare tokens, but because under the perspective of the Brazilian tax authorities, there is capital gains in the Bitcoin. So Bitcoin was acquired by 50 and was bartered by 300.
So as if you sold it for fiat and then bought the other token with it.
Yeah, but in my perspective, this is clearly unconstitutional and illegal by a simple reason, my friend. Let's imagine the following. I have no fiat money, okay? All my economies are in crypto. Income is something that, broadly speaking, regardless of the country that you are, is something that is positive in your patrimony. Income should not be confused with the patrimony. So when I have this situation of taxation, is very odd to me because if I am a person that, by example, do not hold Brazilian reais or any kind of fiat currency, I would need to sell a portion of my recently acquired Blocksquare tokens to fiat currency in order to pay the capital gains that I supposedly got in Bitcoin. It doesn't make sense.
Yep.
Because I actually exchanged it. I have a barter. If I had 300 in my patrimony, okay, my wealth, I have 300 Bitcoin. Now I still have 300, but I have 300 in Blocksquare tokens. So there is no income, there is no capital gains.
Dennis,
the position is
Daniel
the same.
is hinting that Blocksquare tokens very soon, BSTs, will be worth as much as Bitcoins. He's saying that. I have him on record. So thank you, Daniel. Amazing. So what you're telling me is, and I want to explain it in a different way. I want to say, forget about cryptocurrencies and forget about any other method or unit of exchange. Let's say you have barter. Take it to our ancestors' times. We have oranges, apples, and watermelon. And the minute you've exchanged oranges to apples, if you had 100 oranges, and this year there is scarcity of orange produce because the orange season was not so good, and you were able to exchange them to 200 apples, does this mean you need to pay off some of the apples because you've made here a successful trade, if we would say? So I believe if we remove the crypto element from it and even the fiat element, I agree 100% with you. In general, it should be non-constitutional. I'm exchanging something to something else, that will retain the value of the first item at the time of exchange. So yes, it doesn't retain the value of the first item at the time of purchase or acquisition, but it retains it at the time of exchange. In other words, it's similar to continuing to hold the same item value-wise. And then the variation in price or in value afterwards should not be probably taxed, except if you sell it or you dispose it, isn't it?
Yeah.
Because otherwise you're revaluing that item. And let's take it to real estate. Forget about even currencies. If you have a property today and you exchange it to another property, a land, and you exchange it to a house, do you pay capital gain now on the land if you did not pass through fiat currency, if you did not pass through currency at all?
Here in Brazil, no, because we have a specific exemption for real estate. Perfect. But in my perspective, this should not be only exemption for real estate. Should be the general rule. It doesn't make sense.
It's logical.
To tax barter transactions.
Exactly, it's logical. It's logical because, again, you still hold the same value. And you still hold the same value as long as you barter and hold. Now you tell us that there's somebody that can be considered a caveat in the law and somebody can continue bartering. I would tell you, if it has a caveat, it will be a good one. It will be not the last one. Probably there's many other caveats in the law that people benefit off and should be diminished. So, so let's go back to something super interesting also on the idea of exchanging crypto assets. Now you said that crypto assets are not all alike. Let's say you're exchanging from one category of crypto asset to another. Would it still stand the same test of changing Bitcoin to Ethereum or not?
I understand that, yes, because the value remains the same upon the date of the exchange of the barter. Okay. Depending on the country, it is interesting to get noticed and to understand the nature of the token.
Let me point something here, Daniel, because if we consider it inventory, or if we consider it non-tangible assets, if you exchange currently a non-tangible asset on your balance sheet to another non-tangible asset on your balance sheet, are you taxed?
In Brazil, yes.
Okay, cool. Okay.
Yeah, fortunately, yes. But there are jurisdictions that do not tax this operation. They only tax on the cash out to fiat currency.
Perfect. So what's also in your book? Tell me what's also in Bitcoin.
Perfect. In Bitcoin, I divided my studies in like a path. I understand that several countries, they divide the taxation competence or the taxation powers depending on the way you expand, on the way you acquire income. That is why at first I began with an introduction about the history of money. Actually, it's just a brief introduction because I am not an economist, and I understand that the limits of my knowledge are the limits of my language, and consequently are the limits of the science that I got my bachelor's in. So the idea is in this introduction is to show that at the end of the day, especially when people gave up on the fact that dollars and currencies are not pegged to gold anymore, when humanity abandoned this pagancy to gold, it was very clear to me that the value of fiat currency is, as the name itself, the trust, fiat, the trust you have in a government, in the structure provided by a country. So the question is, and there is a very interesting example. Imagine we have a person that unfortunately had an accident sailing in the seas. This person survived, the one and only survivor. And his man started to live in an island. He has a knife, okay, with him. The knife is useful to cut vegetables, fruits, to defend himself for wild animals, for example. Imagine that he found a chest full of gold coins. Tell me, what is the value and how is worth the golden coins inside the chest? They are useless because of the context. So the value of anything in the very nature of humanity depends on the consensus that a community sees in an asset. That is why gold has its value, and that is why nowadays we are seeing Bitcoin thriving in its value when we have more consensus about the acceptance, about the value. But we have nothing pegged to it. We are always coming back to trust. Yeah. We are always coming back.
However, with the differentiation of the fiat currencies, and this is something very important here. Although, guys, remember, I'm not a Bitcoin holder, and I'm not a man who advocates purchasing Bitcoin. I should have 10 years ago. I haven't. So today I'm not. What I'm saying, however, is when we depegged from gold, and I'm not a gold holder, by the way, and I'm not saying purchase gold because I'm not a gold believer at all. I believe in intrinsic assets and intrinsic value. And I believe gold does not hold any. Yet, or does not hold much, let me not say any. Today, when we talk about pegging fiat currencies, pegging it to anything, peg it to apples, peg it to books, peg it to paper, peg it to anything, has a value that is different than the valuation today of currencies, just because pegging it to something limited allows that sense of limited scarcity. Bitcoin today does have that sense of limited supply. Yeah, while fiat currencies in general, and it's proven over and over again, do not. Now, I do believe every currency should be issued by a central bank. Anything else that isn't issued by a central bank, I wouldn't call this a currency. I can call it a medium of exchange, call it barter points, call it, there's barter card. Have you ever heard of barter card?
Yeah.
It's, I believe, an Australian company that's thrived, and it's bartering. It's exchanging stuff, points, barter points. So it does not matter. You can peg it to anything you want. It gives it that element of scarcity. Bitcoin today does have it. This is what I wanted to intrude with. Sorry, go ahead.
Perfect. No, it's perfect. So in this introduction, I end up to the conclusion that money is a social mechanism of exchanging value, because we depegged fiat currencies or commodity currencies that became fiat currencies. Once I succeed to conclude in this introduction, I start to analyze the technology itself. So at first, I explain what are the differences between distributed ledger technologies as a gender and blockchain as a species of distributed ledger technologies. And this is interesting to get to know that we are always talking about information. At the end of the day, it's very interesting to know that we are always talking about information, and consequently, we are always talking about language. Language and data is the future of value in this perspective of such disruptive technologies. So in this chapter, I started describing how the technology works and what are the functions performed by the technology itself. I started to explain DLTs, then blockchain, and then I start to develop some concepts about Bitcoin itself. So I tried to explain, but for non-technicians, or what I mean by that, for people that are not initiated, for you, for me, for other lawyers, other accountants, for my parents, I tried to explain what is Bitcoin and what are the functions performed by the items of this ecosystem. For example, what are wallets? What are their purpose? Why I used to say, for example, that on-chain tokens, they are not something that you can actually touch or hold. You are not saving them like a PDF file, nothing like that. So I try to cancel these myths and explain these differences. After that, I understood in my book that the solid grounds for the philosophical perspective and the technological perspective, they were fulfilled. And then I started to explain about the possible taxes that would be levied. And I take the Brazilian case as a case of analysis, but this could be exploded to other jurisdictions that have similar taxes. So I divided on consumption taxes, just like VAT, that in Brazil we call ICMS. is a tax levied on the consumption of goods and transport services. Then I move forward to financial taxation, like we have a specific tax that is the tax upon financial transactions, IOF. There are some countries that have it too. And then I enter in the most interesting, in my perspective, part, that is the income taxation, capital gains taxation, and revenue taxation. Because there are some countries like Brazil that the revenue is taxed regardless you have or have not any profit in your operation. And there are some specific chapters that would be useful for any kind of jurisdiction, any kind of taxpayers, that they are dealing, for example, with these such hot topics: how to tax mining, how to tax staking, if you should or not tax barter transactions regarding crypto, what are the categories, what are the arguments to defend yourself if you do not agree with this taxation. And then I conclude with some compliance measures regarding crypto, what should taxpayers be aware of, and in international transactions, how you would qualify the transaction upon double tax treaties. So, for example, there are several double tax treaties that are in force nowadays. Brazil has its own network of double tax treaties. Each country has yours, so it's important to get to know, if you are involved in an international transaction, how you would qualify this. It would be business profits, it would be royalties, capital gains, and this depends, again, in the nature of the token and the functions performed by it and the usage that is granted or made by the holder, by the user. And then I finished my book just saying why we have a chameleon on the cover. We have a chameleon on the cover of the book because tokens are just like chameleons. Depending on the context that they are used or they are held or the economic rights within them, we should have specifically regulation for these differentiations. So it's not about the concept, but it's about how it's used. For me, this is the future of the world, and all the best regulations, in my perspective, they will thrive if they have awareness about this. For me, it would be very, very bad to say something like, all the tokens are financial assets. This makes absolutely no sense. But there are some jurisdictions that they are dealing or they are flirting with this kind of perspective.
You know, regulators are driven, I always say, by fear more than greed. Fear that something affects a community in a bad way rather than greed of having a benefit of it. Well, we are in some jurisdictions like in Dubai and UAE have motivated regulators. They want to innovate. There's a vision, there's a drive to innovate, and that's helpful. And I believe such legislation or legislatory bodies and environments allow pioneering ideas and thoughts to thrive. Daniel, I can talk to you for hours and hours. Before I talk about the future and what you see in the future.
The same, my friend.
I have a very, and because of the flood of questions, it's the first time I need to write my questions, yeah? So you talked about a subject that's very important, and I believe many people who know crypto or believe they know crypto, trade crypto, they do not understand the differentiation that you've put forward there in a very simple manner. So how can you describe the differentiation between distributed ledger and blockchain as the species? How can you describe it in a very simple terms for every one of us who's not a tech-savvy person, who thinks he understands crypto, but most probably he doesn't?
Perfect. Well, distributed ledger technologies, they are, let me put this way. Let's imagine an Excel file, okay? And let's imagine that we have 5 people in our group, me, my brother, Macron, your partner, and Dennis. And we have so much trust between the 5 of us that we know that it's like a blood connection. We would never, ever cheat ourselves. So trust is 100%. If I take this Excel file and I create a Coinbase transaction, 1,000 tokens, and I in the second column, I take the description of the tokens that I am sending to you. In the third column, I put the output that would be your address, and then I sent you an email for you and for the other members of our network. This is the main concept of distributed ledger technologies, okay? But with a difference. Here I am taking an explanation that is Web 2.0, and that is something that is not distributed, not decentralized. So because I trust you guys, when you receive this transaction, because I put your output, and you decided to send some coins to Dennis, you would fill the gaps in the second line, fill the columns, and then you would send again this Excel file to all of us. But this is the main concept of distributed ledger technologies. They are nothing more than a balance sheet that is distributed, a ledger, a system of entrances, of inputs and outputs. Blockchain is the way you organize this information. So when I have this ledger, this chain of information, and I organize it in the form of blocks, that is when I have blockchain. Okay, but I can organize it in different ways. For example, I have Hedera hash graph. Hedera, Gabar, H-bar, the token, is a token that people think that is in the blockchain. But no, it's their own technology. They have hash graph. Hash graph is a distributed ledger technology, but it does not confuse itself with blockchain.
Because it does not organize it in blocks, in other words, yeah?
Yeah, at the end of the day, just like that. And the same for IOTA, for example. IOTA is traded in the main exchanges, and this is not financial advice, guys. I'm just giving examples of different categories of distributed ledger tokens, not blockchain tokens. And IOTA is something related to Internet of Things, and they do not organize their info like a blockchain perspective, but still they are distributed ledger technology.
And look, I've put a paper. Actually, it's not published yet. It's I've put a paper for Fibri a few days ago, and what I've done is, in a very simple way, I inspected the history and I saw elements in history that look like distributed ledger. So, and I looked at several elements. Now, definitely, when I look at it, Daniel, I look at it from a property perspective because I'm a property guy. But when I looked at records, because part of property is recording the ownership and recording the property, I found out that hundreds of years ago, we created a distributed ledger. How did we create a distributed ledger? Yes, we had no internet and we had no computers. However, initially, they used to record your birth and my birth in our villages on a book with witnesses to confirm the validity of those details. With time, we discovered that this book may be manipulated and may be eroded with time. So we need to create, probably on a town's level or on an area's level, a book that has all of those records. So regularly you create the initial record in your town, in your village, and then you take those records and you consolidate them and you align them with the records in the town or in the area. And then with time, we discovered that also this can be manipulated. So we said we will need several checkpoints and we will need several locations on a country level where this same data is distributed to too many places. Yeah. And by effect, this is a distributed ledger. Yeah. We had no computers, but this is a distributed ledger. We're distributing that. And as long as after that, we defined it in a way so that we can search through it. That's similar to organizing it in blocks, or in other words, sometimes we distributed it by village and then by family and some other times we distributed it by rather than by village and by family, we defined it by alphabetic order or any other order. And all of those are similar to the ref hash, similar to the blockchain. It's ways of organizing all of this data. Yeah,
exactly. Your example is amazing, Macron. I would enjoy very much reading your paper. Please send to me
in the coming few
because
days, sure.
At the end of the day, it's like just these villages or these towns or these areas, they would be the nodes. Okay, so that is why at the end of the day, if we take by more like brainstorming here, just a philosophical perspective, but people seek trust. People seek trust. That at the end of the day, that is it. Real estate is trustful because it exists. You can touch real estate. The other things, they need trust. So that is why I believe we came for example, the when talking about sovereignty, I think we came to a point in which everything started with the sovereignty of nations. In my perspective now, we are living the sovereignty of big corporations like Google, Facebook. We know how strong they are, how can make influential, how can they influentiate people, even in elections, for example. But now with DLTs, regardless the way we organize this info, I understand we are going to a third phase in human history. I think that I expect to be the most beautiful one. That is the sovereignty of the individual. And the sovereignty of the individual is totally related to trust regarding info and data. At the end of
Daniel,
the day, I think we are going for
my
this.
man, I want to create a show that's called the Low Talk. So, look, exactly what you're talking about, the future. I called it the evolution in this same paper, by the way. I called it the evolution of the habitual behavioral DNA. So we have an evolution of our behavioral DNA. And I believe in the future, AI would be able to draw that behavioral DNA, and then we can expect what would someone react to anything else. And by the way, on my email, that I sent to you recently, you will see an article. Read my last article. It's an article that talks about trust in a trustless world and economy, because I believe we're going towards trustless, but there is trust. Trust here does not mean, or trustless does not mean the lack of trust. Trustless here means the availability of trust without trusting an individual, without the need of yours to trust an individual.
Perfect.
Daniel, so we talked about here, we tanged to the future, and we have just 10 minutes. Actually, we have 10 minutes after the 2 extensions I've put together. But I'm sure we'll bore no one. And I'm sure that everyone loves what you've put forward here. And really, you should be out there more often. Probably you will not be able to work after that, but this knowledge should be distributed around, and people should be aware of that. And because that is reality, guys. This is fundamentals. This is the science behind it. The hype behind it does not get anywhere and anyone anywhere. Daniel, how do you see the future? You said something, you said you see it beautiful. I see it fascinating. I see that the future is amazing. But how do you see the future of what we're doing? How do you see the future of tokenization in general, cryptography, the utilization? Taking into consideration that all of this technology, similar to all technologies that passed before it, is transitory. Every technology is transitory. Every piece of science we've ever known has been true until we proved the opposite, or until we prove different. And it's ignorance to think that this technology is different than all the other technologies that passed. It's evolutionary. And yes, we regularly reject it and we refuse it, but that's the future. So what is the future? Can you define it for us in very simple terms, in terms that someone as simple as me, I can't really take on very complex statements. How do you define it to me and to people who are listening to us today?
In my perspective, the future is related about the value of personal data. I'm not talking about here general protection legislation. No, I'm talking about data and info, behavioral info, intellectual info creation. Okay, the value of creation by each individual, but not only in the context of blockchain. I think blockchain is only the beginning, but that will be a time, and we are already seeing some protocols and some initiatives regarding that we will need to connect 3 different technologies. Distributed ledger technologies, IoT, Internet of Things, and artificial intelligence. I believe when we have a way of merging that according to the needs of each person, we will achieve a very important moment in humanity that probably uh, we will be more equal at the end of the day. I think this is about transparency. And there are only two challenges, broad challenge in my perspective. The first one is leveling everyone on the accessibility of the technology. So we cannot talk about distributed ledger technologies, IoT, and artificial intelligence if all the people have access to technology. We know how many countries, even here in Brazil, depending on the region, they simply do not know what is a cell phone. They do not know what is internet. So we need to take the people that are not familiar with TCP IP, the internet itself. We need to bring these people to where we are. When I talk about we, I'm talking about me, Macron, my brother Eduardo. We need everyone in the same page. And this will take time. This will need economic effort of the most rich nations, because at the end of the day, this is good for everyone. When you have everyone on the same page, you are broadening, you are expanding the consumer market. So this is good even for the rich, okay? Yeah. This is one thing. And the other thing, I think, is education about what you are really in transaction with, about what the technology actually does. So I am seeing some movements in Europe, for example, that they are requiring KYC and AML with non-custodial wallets. I am not against KYC and AML. Guys, I am a lawyer.
We're supporting KYC. I would not do anything that isn't dealing with people who are identifiable.
Yeah, this is very important to know. But we also need to know that, for example, for non-custodial wallets, it's practically speaking unfeasible. You will, or probably you can kill the segment of the market that is going to provide non-custodial wallets. So it doesn't make sense in this, not because I don't want KYC or I don't want AML. No, because it's not feasible. So let's try to find another way to achieve the same result. So let's create, for example, in UN, in OECD, let's bring all the countries that are not part of these organizations together to build a unique database that would have the how can I say, the register of people. But this would be only accessible for the countries for purposes, for example, of security, okay? Or to counter terrorism. But people would be able to trade with this individual sovereignty token or entity or address. So you simply would not need KYC in non-custodial wallets because Daniel connected through his global identity, for example. 100%. And his global identity
unifying the identity is major.
Yeah, and this identity would remain anonymous, or as I say, pseudo-anonymous. So at the end of the day, I think if we have more education about how the technology works and what are the limits depending on the segment of the market, and we level people to the same place so everyone has access to this, we will be able to achieve this triple technology perspective I mentioned before regarding IoT, DLT, and artificial intelligence. And I believe we really can go to a place where probably health will be like something incredibly longer, many years of living, things like that. I don't believe, for example, I don't believe, for example, in robots overruling humanity. No, I think that we need to understand the power of information and data. Humanity will be overruled not by robots, but by humanity itself if we remain centralizing information and data in the hands of few. That's the thing for.
We will evolve. I'm sure we will evolve. There's no way we don't. And we always evolved, and we will continue to. Yes, we struggle because we reject it. I believe I can define here humanity and the evolution of humanity and the struggle that happens between pioneers who are trying to evolve, and government and legislators and people who are still attached to the past whenever it comes to evolution, to the growth of a crab outside its shell. You know, the crab's shell does not grow. It's solid. The crab yet is born as a pea and grows to a significant size. And the only way it does this, and you know the crab is tissue, it's soft tissue. What happens is with time it grows big for its shell. So the crab goes through one of the processes that is considered the most painful. Actually, it's the second most painful after labor, as they say. And that process is to detach its tissue from the shell and exit and hide under a rock or a hard place until it develops a new shell. And that new shell is bigger, and then eventually it lives this over and over and over again. And this is how we evolve as humanity. It's always painful, it's never pleasant, but it's needed, it's a must, and we will do it. Otherwise, we will stay the same size, and it will not happen. So in my paper, I defined the metaverse to us. And I'm not a fan of what is said about the metaverse today and the hype around it. I'm a fundamentalist. However, the metaverse to us today, and I was talking about our behavioral or habitual behavioral DNA evolution, is similar to what a flight simulator is to a pilot. You can experience in a flight simulator everything that you would rather experience in a simulator rather than having it on a real flight. And I believe this same thing happens and takes place, or a similar thing happens and takes place whenever you are in a metaverse. I believe people will be gauging experiences, learning new things, and developing new skills through that. Daniel, super interesting. I enjoyed so much, and I hope that everyone enjoyed as much as me. If Dennis was here, I'm sure he would have added richness. But hi to everyone in the Blocksquare community, everyone who's an enthusiast of what's right, enthusiast of Ocean Point and the future that we get here. I really appreciate your time, your knowledge. Again, I will have you there for hours. Guys, for whoever reads Portuguese, Bitcoin is where you should go and what you should read. For whoever doesn't, wait for the coming version, which is in English, similar to me. It's so appreciated, all your knowledge and all what you put to not only get this knowledge and acquire it, but also to develop it, because I believe you're on the forefront of technology and future development of humanity. Tech is there to make human beings' lives better, more efficient, more transparent, more convenient. It's not there as a fancy thing because we love tech. Any last words, Daniel, before I let you go?
I just would like to thank you so much, Makram, because since our first meeting, I could sense that you are a guy that has so much knowledge about human beings per se, and all the surroundings. Technology is just one of these factors. So I was blessed to get this opportunity to get to know you in Dubai. That is the reason why I should probably public thanks here Rubens and Jason, because they allowed me to get to know you. So thank you so much for all the amazing conversation in this and the brief. Amazing, really amazing, and for the chance to talk a little bit more about my book, the research that I have been doing, and I am really grateful. I think this was I just arrived in Brazil, so for you guys that are listening to us, so you guys know, so there is no better way to start my journey here in my hometown again, but being present here with my friend Makram to talk in the brief. I'm really honored and really thankful for that.
Welcome to The Brief. Thank you for joining us today. We're analyzing what matters. What we try to do is add value to you, our community. Thank you, Daniel. Thank you, Rubens. Thank you, Jason. Thank you, Anna. Thank you, Elifas. Guys, we have amazing people within our community, and we're growing as a bigger community every day of people who do care about what's right and what matters. Welcome to The Brief. Ciao. Have a good day.